Think Realty Nation, it's your host, Abhi Golhar. Welcome to the Think Realty podcast. Now, if you've ever wondered where to find more deals, which I'm sure every one of you have, you've tried the yellow letters, you've tried the postcards, you've tried going to the REO events, you've tried doing all of these things. And at the end of the day, you're looking for something else to break, some extra strategy that's going to help you get in front of more deals quicker that not a lot of folks are taking a look at. Well, this is your show. My co-pilot on this show, that's an inside joke between the both of us. His name is Jorge Newbery. He's with PreREO.com. And we're going to have a conversation about what pre-REO means. It's kind of an interesting conversation. I've never heard of this concept, but I'm going to learn about it. You're going to learn about it. It's going to be a good time. After that, I have a little surprise segment in for you. So let's roll with the show in a second. I'm going to bring George on in just a minute, but I do want to give a huge shout out to the podcast sponsor, who's Clint Coons of Anderson Business Advisors, nationally recognized for providing bulletproof asset protection, tax, and business strategy advice to real estate investors. Go to www.getbulletprooftoday.com and receive Clint's book, Asset Protection for Real Estate Investors, for free. All right, let's get it started. George, welcome to the show. How are you doing, man?
Thank you very much. Great. Thanks very much for having me on.
You got it. So give us a little background. Who are you, what do you do, and what on earth is pre-REO?
Sure. My name is Jorge Newbery. I'm the founder and CEO of PreREO. I'll give you a brief history. Almost 20 years ago, 16 years ago to be exact, I owned about 4,000 apartment units across the country, and an ice storm hit my biggest holding, 1,100 units in Columbus, Ohio, triggered an extraordinary sequence of events in which I lost everything and ended up $26 million in debt. I rebuilt myself through a company called American Homeowner Preservation. As that was all that bad stuff to me happened in 2004. Fast forward 2008, I see that millions of homeowners across the country were facing similar challenges to what I had faced. And I started a nonprofit called American Homeowner Preservation, which had a mission of helping families at risk of foreclosure stay in their homes. And we rapidly determined that the best way to do that was to actually buy their mortgages. And that's what we started doing. In the last decade, we've bought over 10,000 mortgages. And these are typically secured by almost always the mortgages in default, and the homes are the homeowners. Many times their homes, sometimes some of the homes are occupied and the families want to stay. We're able to make deals like modifications and whatnot. But where we struggled the most, and we discovered that other lenders struggled the most, was when you have a vacant property and you're the mortgage holder, the mortgage is in default, and the homeowners left. Maybe they passed away. Maybe they just moved out because they realized they couldn't afford it. They didn't know what to do, so they just left. Now we try to track them down. If we can track them down, maybe give them cash for deed in lieu, we get the property. But many a times, can't find them. Maybe it's a divorce and husband wants to do it, the wife doesn't, or vice versa. And we end up foreclosing on a vacant home. Now, it sounds like easy. Well, no one's fighting it. That should go fast. But the answer is not the case. In many states, the foreclosure process is very slow. I'm in Illinois. Today, it's going to take you at least a year to foreclose on a property in Illinois, even if no one is fighting the foreclosure. In New York, it could be 3 years. So think about that. We as a lender own a vacant property that no one's taking care of, and so we have to step in and take care of it. As a lender, we're required in most states, we'll cite you if you do not cut the grass, if you do not shovel the snow, if you don't maintain the property. And these properties being vacant can be magnets for maybe kids breaking in and hanging out, but also vandalism, crime. All these things happen oftentimes at vacant homes, and it can get extreme, whereas we will have a property and the city may cite us not just to cut the grass or shovel the snow, but they might say, hey, you have to repair the roof. We now have code enforcement involved. We're getting notices, do all this work to the property or you get fined. Worst case scenario, they'll actually demolish the property or threaten you with demolition. And even, I'm in Chicago, which does something really extreme. If a home is vacant and it becomes a magnet for crime, and we own the mortgage on that, the city may order that we post a night watchman. Now, what that is basically a security guard who you're paying to be at the property every night for a property that you don't even own. We simply have the mortgage. So in my mind, I've always been thinking, we're not the only ones with this problem. Hedge funds, banks, everybody across the country who owns non-performing loans secured by vacant properties has the same issues. And we're in Chicago. Other funds may be in New York or scattered around the country, but they'll oftentimes hold assets, again, in all cities, large and small across the country. And they don't know the market as well as maybe a local investor does. So I came up with pre-REO. And what a pre-REO is a vacant property secured by a delinquent first mortgage. And our goal with pre-REO is to connect a local investor with that mortgage, and the local investor can execute a strategy of having a court-appointed receiver appointed while it's still a mortgage, before it's a property, to repair and rent the property during this 1 to 3 year foreclosure process. So revenue is generated to offset the taxes, insurance, maintenance, and other expenses. And also, an occupied property is typically maintained much better than a vacant property. So that's the opportunity. What we're trying to do now, we have a lot of lender interest. Some billion-dollar hedge funds are posting properties on pre-REO. We're now trying to build up our buyer base and have local investors who want to participate on these notes, and they're priced very attractively. So, and we have a strategy and roadmap to follow, which we think can be beneficial for communities, beneficial for lenders, and beneficial for those local investors.
So, given where you feel the market is today, how many pre-REOs are being loaded onto your platform? Are you finding, are they coming in by the hundreds, by the thousands? Is it a result of COVID-19? What's happening?
It was accelerated by COVID-19. But it is right now in the hundreds. We expect by the year end, it will be in the thousands. Currently right now, we're seeing a lot of defaulted fix and flip loans. Prior to COVID, the consumer market was generally the delinquency rates were almost at all-time lows, but that is changing rapidly post-COVID. There's a lot of forbearances and other assistance that's being provided right now to keep families in their homes, and even to stop foreclosures. In some cases, we can be foreclosed that the home is vacant, but that is going to change. The assistance can't stay in effect forever, and we think by the end of the year, early next year, there will be millions and millions. I mean, this is a sad situation, but millions and millions of families at risk of foreclosure. And some of them will just leave their home, or the homes will be vacant. People I hear about so many people passing away that I know that it is, there's going to be a lot of homes that, unfortunately, people lived in, they pass away, and maybe they were underwater, and the homeowner ends up, they owed more than the house is worth. No family members step in to claim the property. It just ends up in foreclosure, and would be a ideal pre-REO.
So for the pre-REOs that you currently have on the system, question one, what markets are they in? All major markets, or every city across the United States?
Yeah, I won't say every city across the United States yet, but certainly the major markets are generally well represented. There will be concentrations, though, in judicial foreclosure states. And just so for your audience who maybe are real estate investors don't pay attention to foreclosures, in some states, it's a judicial foreclosure, which means that it has to go through the court. And those are generally almost always going to be slower than the alternative, which is a non-judicial foreclosure, which is done outside the court system and can go quite fast. And quite fast means a few months, anywhere from, call it 2 to 6 months on average. And then the judicials are like 1 to 3 years on average. And so there's a big difference. So as a result, a lender may think, hey, this is going to be foreclosed on in 6 months. I'm not so interested in selling my assets in California, for instance, because it moves fairly fast, but I am interested in selling my ones in New York because that is so slow. Now, COVID has completely transformed everything. And right now, California is moving very slow with foreclosure moratorium in place. And across the country, their foreclosure moratoria in place. So as a result, even the fast states have become slow. And I think what creates the opportunities just in this market in general, not specifically to pre-REO, is the unpredictability.
Yeah.
When it's harder to make money when there's predictability in the market. Today, no one really knows what is going to happen over the next 6 months, a year to the real estate market, to the economy, and that creates the opportunity. There's going to be big winners, big losers. Hopefully with pre-REO, we are creating a platform where we can help a number of local investors be rewarded. And the reality is right now, I'm sure you're hearing it from your listeners, that the REO inventory is shrinking dramatically. We have a lot of REOs. They're all selling, and they're selling at in most cases, prices that are better than pre-COVID. But the inventory, the reason they're selling so fast and at such high prices is the inventory is just shrink. And so pre-REO is that inventory is growing. And this is something where, regardless of foreclosure moratoriums, in most cases, you can still go ahead with a receivership and start generating income, which mitigates that big risk, which is the passage of time on a vacant property. There's no income coming in, and it's just an expense.
And I think the other potential risk too is, if I'm an investor, what's my exit strategy in a world where folks are not buying, but they are renting? So maybe the exit strategy is the rental, and it's not necessarily to take over, foreclose, fix and flip to somebody that can't necessarily buy, because it looks like, from what you're telling me, from the sound of it, that there's going to be a lot of buying in activity, even though there is a lot of demand for that. And I think that's a very interesting proposition. So from a velocity perspective, if I take over one of these mortgages and I'm going through the foreclosure process, and it's going to take 1 or 2 or 3 years, what is the best case outcome for that investment that I'm making on pre-REO?
So these are typically being priced. Our guidance, and the sellers can obviously set the prices that they want, but this is typically the guidance we provide, and most are kind of following it, is if you think a property price a pre-REO at 75% of the REO value. So if you were to foreclose on this property today and you were selling a deed, you could sell it for $100,000, sell it as a pre-REO for $75,000. And so it's a 25% discount from day one, and the local investor will have the ability to do something the national hedge fund cannot do, which is to execute this strategy. And we have a national law firm that can help facilitate foreclosures and receiverships across the country that is working with us on this, and they will help appoint a receiver. And the receiver is typically a real estate agent who's looking to get maybe 10% of the rental income, as well as, once the property is foreclosed, they're hoping for a listing. There's no requirement that the investor who partners on these actually ends up listing it. But if they choose to, then the real estate agent, obviously they want listings. If they get half of them turned into listings, I think they'll be happy. And so that's how we structure it, so that local investor can actually start generating rent, just like as if they own the property on something that they've acquired at a 25% discount. And then also there's that, provided values stay where they are, which, who's to say whether they go up or down, then, by the time you foreclose, at the time the foreclosure is completed, the local investor can choose to do either continue to hold it as a rental or resell it, whatever they feel is appropriate.
So those are primarily the two exit strategies, which makes sense. From an REO perspective, from what you're telling me, you think that, hey, it's going to keep coming. This entire market is just going to, from what I'm understanding, it's going to tumble. There are going to be more REOs, hence more opportunities for investors to pick up these REOs or these pre-REOs at reasonable prices. Would I have to get into a bidding war for some of these?
Sure. So we're seeing more and more. We're seeing multiple offers on assets. Okay. So we are seeing so that is happening. I won't call them bidding wars yet. We don't have we have, I think, right now 1,400 buyers on our platform. Not big, but not small. And again, they're spread out across the country. So we do have gaps in smaller markets where there are rural areas, certainly, and some smaller cities where we don't have we see very little activity because we don't have buyers there yet. And we're proactively reaching out to real estate investment associations through other types of groups, even through real estate agents, to say, hey, we have this. Maybe if you help find a buyer, we can, they can go through this program. Eventually you get the property management and listing. But we're trying to proactively fill in those gaps. So there are healthy bids on all of them, because ultimately right now, most of the sellers that are coming on the platform are testing it and saying, hey, okay, makes sense. But these things now we got to prove it and sell them. And I'll tell you that the pricing from an REO buy perspective, someone who traditionally buys REOs, fix and flip, or somebody building a monetized rental portfolio, the prices should be extraordinarily attractive.
I'm going to check it out.
Just to answer your question, another detailed question.
Sure.
Across the country, price ranges from like $10,000. There's even some even smaller, up to closing one I think tomorrow. Our biggest one yet. It's a $3 million home in Florida, and they're buying the note for significantly less than that. I think it's around 60%.
That's significant. That's awesome. Okay. So how do I get involved? What do I do? I go to PreREO.com. Is that
you go to PreREO.com. You can register as a user. It's just like, I think, a name and email. You can register. Then you can see all the full details on the assets that are available. You can bid. You can ask questions. We do pretty regular webinars. We're trying to educate. I mean, it's a new process, and we're trying to nurture. I mean, I don't want to, although we've had some interest from REO to rental, like bigger groups, maybe regional groups. I really see the advantage being that local investor, and that's who we're trying to connect with and educate. And one thing I didn't mention is, they may think, hey, I'm buying for 100, I got to pay 100. We've actually made it so that we finance 75% of everything that's offered on the platform. So that should help make it more accessible to pre-REO buyers.
I just thought of a marketing strategy for you. You're familiar with B2R, right? Like build.
Sure, absolutely.
And then like this entire BRRRR concept. You should maybe think about doing like an R2R, right? Like REO to rental, or like R to
yeah,
F,
exactly.
right? Like REO to flip. I don't know. It seems kind of interesting, right up your alley. But this is great, George. I mean, I learned a lot. This is really neat. I'm gonna go check out PreREO.com. And I certainly appreciate the time coming on board and talking a little bit about this concept with me. And it looks like there's going to be plenty of opportunity to come. So certainly appreciate it. If there's one gold nugget, we got to run. But if there's one gold nugget that you can offer our listeners, what would it be?
It would be do what everyone else is not doing. So typically, when everyone's buying real estate, probably not the best time to buy. When you're the only one buying, you'll get the best deals, and that's the time of today, like uncertainty, when not to make foolish choices, but to take calculated risks. That's the way that you generate the biggest rewards.
Bingo, George. Thanks so much. I appreciate the time.
All right, thanks a lot.
You got it. This next segment is brought to you by Clint Coons of Anderson Business Advisors, also the sponsor for today's podcast, nationally recognized for providing bulletproof asset protection, tax, and business strategy advice to real estate investors. You want to go to www.getbulletprooftoday.com and get his book titled Asset Protection for Real Estate Investors for free. How do you get a good deal in a seller's market? This is an article written by the editorial staff on the thinkrealty.com blog. You want to check it out, go to thinkrealty.com. You see what I did there? Twice in like a sentence. And there are a couple of strategies you can deploy. Number one, you can make lots of offers. That's one thing they talk about. I guess I can kind of see it. For every 100 houses you look at, quote, you may make 10 offers, and from those 10 offers, you may have one accepted. You want to make, if you're going to make 100 offers, make 100 smart offers. Not like 100 offers at $20,000 a house, $20,000 per house, when you know that that number won't stick with the homeowner, especially when the market value is anywhere between 80 and 110, unless that house needs major rehab. So, do I generally agree with make lots of offers? Yes. But make smart offers, and a lot of smart offers. Number two, you can waive a lot of contingencies. So, example, financing contingencies. You won't need that if you just go to a hard money shop or a good private lender that pretty much is cash, and it's really fast cash. That's one contingency that a lot of homeowners have an issue with. Number three, offer more earnest money. That's another really big thing. If you're only offering $100 in earnest money and there's a buyer, potential buyer that comes behind you and says, hey, here's $1,000, well, guess what? That's like saying, see you later to your $100 earnest money offer. So offer more earnest money. And you also want to craft the right offer and also get to know why the seller is selling. If you can empathize with their needs and empathize with the situation they're going through, maybe write a letter and then craft an offer where they really feel that you're the genuine buyer that's going to take care of the home, you're going to win 100% of the time. There are a few other strategies in here that you should definitely read about, so go to thinkrealty.com, check out that blog, and you won't regret it, I promise. Think Realty Nation, that's the show. If you have any questions, you know how to get in touch with us. Go to thinkrealty.com. You can find me anywhere online at Abhi Golhar. And another shout out to the podcast sponsor for today, Clint Coons. Great guy, great friend of mine with Anderson Business Advisors. They're nationally recognized for asset protection, tax, and business strategy advice for real estate investors. So if you're a real estate investor, go check them out at www.getbulletprooftoday.com, getbulletprooftoday.com, and receive Clint's book titled Asset Protection for Real Estate Investors for free. This is really important information. You want to make sure that you cover your assets. You see what you did there? Yeah, all right. Okay, I got it in the show. I've got stuff to do. I know you've got stuff to do. Until next time, Think Realty Nation, happy investing.